Good to have you here with us. Amid this recent volatility, you say investors may want to rethink that 60-40 portfolio strategy. Why is that, and how should those percentages shift?
Yeah, thank you for having me on your show. Look, I think the 60-40 portfolio can be misunderstood in some ways as being this magic ratio that's out there. Effectively, the way that the 60-40 portfolio worked the best was really from 1981 to 2021, which was mainly driven by the fact that interest rates declined during that period. 37 out of 40 years, bonds had positive returns in that 1981 to 2021 period. That is what drove the stable performance of the 60-40 portfolio. And it gave you a return between fixed income and equities somewhere around 7.5%, and which was a very good risk-adjusted return. Now, if we imagine a scenario like today, where interest rates do not decline, which means that bonds do not have steady returns, interest rates just move sideways and in a channel, which means that bond returns may fluctuate. If that starts to happen, then essentially that stable return profile in the 60-40 will actually start to come down, and bonds will start to correlate more with equities. And the average return from many of the capital market assumptions that we have might be more like 5% returns in a 60-40 as opposed to what we saw with 7%. And that 5% is going to come to you, 5% return is going to come to you with higher volatility.
Okay, so let's break down, because we just threw a lot of numbers at folks, but let's break down perhaps bucket by bucket where the best opportunities are within each of those percentage allocations. And so if we were starting with, what the equities bucket should look like, what are you identifying there as a clear strategy?
So I think there's two components of this. One is how you manage your money, right? So when we typically think about 60-40, we think about passive investing, like buying an ETF in the S&P 500 and an ETF in some bond fund. That passive strategy won't work as well. The style change is what needs to happen here. You need to start thinking about investing in more active asset managers or active ETFs. So that way the bond component of your portfolio will manage the duration a bit better. So the way that we typically start to think about bonds is I'd have slightly less duration in my portfolio. So in other words, I'd have a mix of high yield, I'd have a mix of bank loans, municipal bonds, for high quality, and also U.S. Treasuries and investment grade. But I'd keep some of the longer duration in the credit space and the higher quality short duration in like U.S. Treasury. So it's more of a barbell type strategy where you can manage the duration of your fixed income component of the portfolio. On the equity side, we have to now really start to think about diversification. So it was really about Mag 7, large cap tech, over the past 10 years or so. Now it's going to be much more idiosyncratic. So we have to start thinking about large cap value. I think mid cap sectors can do well, mid cap value, even a little bit of small cap. So the sectors that we tend to start to like, more trend like, are areas like materials, industrials, even healthcare. Healthcare can be a little bit defensive, but it can also have some pretty good gains, going forward as far as we see it. Even on the financial side, if we think about deregulation in markets, I think financials can do reasonably well. But again, it's really about the style of how you're creating your portfolio, going from a passive type of a strategy to something that's a bit more active.
I'm going to ask you something, Jim. How far away do you think we are from another number within that mix? We've talked about 60-40, we've talked about 70-30, but there are some firms that are talking now about adding on some cryptocurrency exposure, and I knew you probably knew I was going that direction.
Yeah, I love that question because you're exactly right. We should not be confined to two numbers, right? Maybe we should think about alternatives, and that could be crypto, right? That could be also private equity, it could be private credit, it could be infrastructure, it could be real estate. So we can't think of it as just 60-40 equity and fixed income. The new ratio might be something like 60-20-20 or 60-30-10. Nobody really knows what that golden new number is, but I think what most people are really deciding right now is that it's probably not 60-40 passive. So we're trying to look for that other piece to make up for the for the potential lost return in the passive 60-40 portfolio and give you the diversification and stabilization into your return profile. That's really the key. You want to stabilize your returns, and you need diversification to do that. So you may need to add a third asset class, whether that's crypto or it's alternative investments. That's up to whatever the comfort level of the investor is.
Jim, thanks so much for taking the time here with us today. Really appreciate it.
My pleasure.